You probably already know what a passive income is. It is money that you earn without active involvement. Now, who doesn't want that? Money for minimal effort? Sign us up! You probably fantasize about going to bed and having more money than yesterday. When you're just starting out, the amount of money you make doesn't even matter, because that first $1 that you earn passively will get you so addicted that you would want to do nothing more but make your passive income business even larger. That's why today we're going over ways to start doing this with just $1,000. With this, you can make your money work for you instead of the other way around. We guarantee that these ideas are practical and easy to do, and you can get started with them immediately. Although we're gonna have to throw in a big disclaimer. You're not gonna earn Lambo money with just $1,000 passive income. That'd be too good to be true. However, these will get you started on a small scale in order for you to learn some techniques and cultivate it later on. With that being said, let's get right on the video. First on our list is investing in dividend stocks. You know how it works. Anytime you buy a stock, you're buying a small ownership percentage of a certain company. In exchange for being the small owner of the company, you're entitled to some of their profit. Dividends are a way to earn a consistent income stream on a regular basis. A certain stock may not be a growth value option, but if it pays out a dividend, it provides its benefits in that matter. This appeals to many investors because they provide a stable and reliable recurrent source of income. Other than that, when the stock price goes up, they can profit on that as well. So imagine if you buy $1,000 of Apple stock. From that, you're going to make $19.90 every year in passive income through dividends. And if the stock price goes up 8% throughout the next year, well then you just made an additional $80 through passive income in a $1,000 investment. With every $1,000 you invest, you earn between $28 to $64 per year for doing absolutely nothing. However, if the stock price goes down, you can also lose money. But a majority of companies still pay out their dividends regardless of where their stock price is. At the very least, you can always count on this type of passive income. When it comes to dividend stocks, they're never really that rare to find. There's absolutely no shortage of it. Second, we have index funds. Investing in index funds has long been considered one of the smartest investment moves you can make. Index funds are affordable, enable diversification, and tend to generate attractive returns over time. Historically, index funds outperform other types of funds that are actively managed by top investment firms. Index funds are mutual funds or exchange-traded funds linked to a particular market index. These funds aim to mirror the performance of the underlying index they track and are passively managed. Therefore, their underlying securities don't change unless the composition of the index shifts. For investors, this translates to lower management costs and lower turnover rates, which makes them more tax-efficient vehicles than many other investments. An index fund is simply a collection of companies that you can buy into. You then can own a very small percentage of everything. Instead of buying every single stock there is, you can buy one index fund for $261.75. That way you get the diversification of buying everything without literally buying everything. Much like dividend stocks, investment funds don't pay out cash to investors. Rather, they can incorporate stocks into their holdings that are likely to pay a dividend to shareholders. And since you're a shareholder by way of the index fund, you get a piece of the pie, which generates additional value for your investment. Index funds may not have the blockbuster returns of real estate, farmland, or dividend-generating stock investments, but they do produce a reliable source of passive income as your holdings of the fund remain intact. Plus, they're far less expensive than other passive income opportunities in terms of fees. Third on our list is investing in a REIT. Just like how you can buy a stock within a company, think of this as buying stock within a property. With this, you won't have to worry about finding real estate opportunities and managing a property when you invest in a REIT, which means you can sit back and enjoy passive income with far less work. REIT investing is like fractional property ownership. The amount you own depends on the size of your investment. A larger investment gets you a larger return, which means more passive income for you. Plus, with a REIT, your investing dollars can go further. The management firm takes care of maintenance and repairs and deducts a certain percentage from your return. That means you won't have to dive into the nitty-gritty of maintaining a property like you would if you invested in real estate individually. They are total return investments. They typically provide high dividends plus the potential for moderate long-term capital appreciation. Long-term total returns of REIT stocks tend to be similar to those of value stocks and more than the returns of lower-risk bonds. Because of the strong dividend income REITs provide, they are an important investment both for retirement savers and for retirees who require a continuing income stream to meet their living expenses. REITs' dividends are substantial because they are required to distribute at least 90% of their taxable income to their shareholders annually. Their dividends are fueled by the stable stream of contractual rents paid by the tenants of their properties. The relatively low correlation of listed REIT stock returns with the returns of other equities and fixed income investments also makes REITs a good portfolio diversifier. REIT returns tend to zig when those other investments zag, helping to reduce a portfolio's overall volatility and improve its returns for a given level of risk. All of the typical expenses that come with renting a property, such as REITs tend to benefit from low interest periods, which means they can be an alluring investment when inflation is high and bond rates are no longer a worthwhile diversification option. And the fourth are bonds. No, we're not talking about James Bond. We're talking about a fixed passive income source. So this is how it works. Companies, states, governments, and so on will give you a chance to invest in them. If you give them a loan, they will pay you back with interest. These are usually well-established and credit-worthy companies with strong management teams and consistent earning growth. Until the bond matures, you will receive regular coupon payments similar to earning interest on a loan. When the bond's term expires, you receive the face value of the bond, which you can then reinvest in another bond if you want, and continue to receive interest as a source of income. Rather than buying an ownership stake in a company through stock, bonds are a way for investors to lend money to companies, as well as federal, state, and local governments, and collect interest income. Bonds are considered a safer investment than stocks, but also generally earn a low return on your investment. But then again, this is passive income. Bonds have a clear advantage over other securities. The volatility of bonds is lower than that of equities. Thus, bonds are generally viewed as safer investments than stocks. In addition, bonds do suffer from less day-to-day volatility than stocks, and the interest payments of bonds are sometimes higher than the general level of dividend payments. Bonds are often liquid. It is fairly easy for an institution to sell a large quantity of bonds without affecting the price much, which may be more difficult for equities. In effect, bonds are attractive because of the comparative certainty of a fixed interest payment twice a year and a fixed lump sum at maturity. Bondholders also enjoy a measure of legal protection. Under the law of most countries, if a company goes bankrupt, its bondholders will often receive some money back, whereas the company's equity stock often ends up valueless. If you're the risk-averse type who truly can't bear the thought of losing money, bonds might be a more suitable investment for you. Bonds are a good way to diversify your portfolio and protect yourself from market volatility. If you're near retirement or already retired, you may not have the time to ride out stock market downturns, in which case bonds are a safer place for your money. In fact, most people are advised to shift away from stocks and into bonds as they get older, and it's not terrible advice. It's no secret, passive income is one of the most talked about and sought after elements of personal finance, and for good reason. From improving your financial stability to reducing your financial stress, we have yet to discover a single downside to earning passive income. The real question is, what are you waiting for? Let us know which passive income idea you'll be trying out in the comments below. Don't forget to like and subscribe, and we'll see you on the next one.